the time this morning. We look forward to the next one. Okay, so we are down about 0.5% on the market. That's the way this Thursday is playing out. Let's get to our next conversation then. James Sullivan, MD and Head of Asia Pacific Equity Research at JPMorgan, is with us now. James, good morning, and thank you so much for being with us today. We live in very interesting times, and just earlier on the program, we were talking to Jahangir, and he made an interesting point. He said, even if you get a soft landing, even in a soft landing, things still break. So with that context, how should investors look at equities here in India within the Asia-Pacific region? Do you think there's going to be a flight into some of these EMs because of what's happening in the West, or could it get worse before it gets better?
Good morning, and thanks very much for having me on the program. My good friend Jahangir always has very valid points to make. An additional comment or quote that I would pass on to you from Mike Ferroli, who's one of our senior strategists out of the United States, is every time the Fed hits the brakes, something goes through the windshield. And that's exactly what we're seeing right now. You have a series of embedded risks that have piled up in global markets that are now being brought to light through various mechanisms. And if we look at the United States, what we very clearly see, and importantly, is an idiosyncratic conversation where smaller US banks are exposed to a very different regulatory regime than the large GSIB or globally systematically important banks. That differential regulatory regime allowed for some of these risks to build up, and we're seeing the impact of that today. I do think it's important to recognize, however, that is a different regulatory regime than large US banks. And so you are starting to see a deposit flight away from small to large that will have an impact on overall levels of economic growth in the United States, which we have to take into account when we look at broader equity markets. But as we try to extrapolate those lessons here in Asia, again, they are somewhat specific to the US. I think some of the things that we can start to argue is that you will see a more rapid repricing of deposits. We are seeing that in markets inclusive of Singapore, where I'm based. And you're starting to see retail deposits earn higher and higher returns. That was expected. It's happening maybe faster than expected, but that was contained in many analyst forecasts. And so I think it's comfortable to say that the growth environment for a lot of the emerging markets has not significantly changed off the back of recent events. We are still positive on a series of country and sector level stories here in Asia.
James, hi, good morning. So then what is the read through? Is it just purely sentiment hitting markets like India, negative sentiment affecting PE ratios? And because as you say, there is no direct read across, right, from what's happening globally. And second point, on this Credit Suisse situation, can you tell us what's the House view? Will it be contained? Can it be contained?
So if I look at the flow through from the US into Asia specifically, again, we'll see a faster repricing of retail deposits. We will see some impact if we look at a potential slowdown in the US. JPMorgan numbers has about 500 billion in incremental loans coming out of smaller banks in the United States. If we assume all of those go away and are not replaced by lending from some of the larger banks, then that has the potential to create a drag on the US economy of 1%. And so again, per the conversation earlier in the program, focusing on more domestic demand, domestically oriented investments in markets like India, China, and domestic stories makes a tremendous degree of sense for us. If we look at the broader banking system as a whole, again, it's important to differentiate idiosyncratic risks from broader systemic risks. We are not currently seeing systemic risks to the global financial system. And so we're not necessarily sounding alarm bells from that perspective. If I look at a market like India or China, again, domestic demand plays remain very interesting. We are looking at financial services, which have underperformed, where we do see significant incremental potential for loan growth. And we don't see a significant pickup in asset write-offs as we look forward into the next couple of years. And so we're creating an interesting environment. The one thing that I would stress, however, relative to maybe some of the speakers earlier in the program, I do think it's incredibly dangerous to look at 5 to 10 year valuation multiples at the current time. And this is a mantra that we've seen in markets really consistently. And this is a very dangerous mantra from my perspective. Effectively, what you're arguing is that the world today is the same as it was 10 years ago. And I think it's obvious that nothing could be further from the truth. We went from a zero rate environment to a high rate environment. We went from a unipolar world to a multipolar world. There are many, many instances where the world of 10 years ago just isn't relevant to the conversation today. So when we're thinking about valuation multiples, JPMorgan view, and certainly my personal view, is that valuation multiples are relative to something. And so we've got to be very, very careful when we have that conversation in any market around the world.
Got that. By the way, I just wanted to, get our attention back to the markets because the sell-off is getting worse by the minute. The Nifty is now down 75 points, and we're not even 15, 20 minutes into trade. So it's not looking like a good start at all. We started on the back foot, and now it's sort of decelerating by the minute, barely hanging on to 16,900. That as well is gone. The Bank Nifty is down about 220 points. So this is not a good picture at all. But James, good morning. This is Sonia. It's good that you believe that perhaps we're not seeing any systemic risk to global markets. I remember we had a conversation in September of last year where you said that India is in a pretty good place compared to most global markets purely because of the resumption in GDP growth, and you were talking about growth of 6-7% as well. Does that still hold? Do you think India will continue to be an oasis in this desert? Because now there are some concerns emanating about growth as well, especially in the domestic markets, perhaps because of the way the monsoon situation could pan out. What do you do with the Indian market at a time like this?
No, great question, and thanks very much for that. And I think we have to differentiate the short term from the medium term, the fundamental from the positioning data that we have access to. One of the things that we highlighted in a number of our conversations over the course of the last couple of months is the fact that India had become extremely well held, particularly by foreign institutional investors, had become reasonably expensive, particularly in the light of a higher interest rate environment. And we had gone neutral on the Indian market on the expectation that you'd see a pause in market performance, given the fact that most investors were already exposed to the market. What we saw late last year, earlier this year, was a very significant country rotation trade out of India into China as people started to play that China reopening trade. China had gotten very, very inexpensive from a valuation perspective, very, very underheld, particularly if you go back to last November time period, and you saw this country rotation trade into China. We still see what we would argue are potentially the last vestiges of that today. A number of investors are still playing a China reopening trade. In addition to that, you have an SOE restructuring trade ongoing in China today, where the regulatory environment is moving away from an EPS growth forecast and towards an ROE forecast. And you're seeing significant outperformance of safer dividend yield plays like the China telecom stocks at this stage. And so that's offering an alternative. From a medium-term perspective, we still do see very interesting prospects for India. And again, it all comes down to growth differentials relative to the region and relative to developed markets around the world. This year, we're forecasting that China GDP will bounce back quite aggressively off the lows of last year. As we look forward into 2024, there are very, very significant questions regarding the level of achievable GDP growth coming out of China. In that light, India looks very attractive from a medium-term perspective.
James, that's really interesting for us here. Can you expand on that? So as you look towards, the next couple of months into 24, calendar year 24, what parts of India would perhaps you look to play? Is it going to be domestic consumption? Is it going to be capital expenditure? Because the government's doing a fair amount of that over here. Some more thoughts, perhaps?
No, great question. And so again, it's the growth differential dynamic that we're looking at, particularly as analysts and investors start to roll forward their focus into a 2024 view. The elements of the India economy that are most exciting to us here at JPMorgan are primarily domestic demand and consumption plays. But to your point, you are also starting to see very selective CapEx programs from large Indian corporates. You had mentioned an upgrade that JPMorgan pushed through on one of those earlier in your program. Part of that story is the CapEx program that company is currently pursuing. And so if we look at the banking system in India, we are still positive. We have been for some time. The recent weakness offers potentially a medium-term buying opportunity. Domestic demand, particularly in the domestic consumption stocks, looks very interesting. And select CapEx plays off the back of corporate spending. One of the things that we got out of the Indian budget is that the infrastructure spending is there. It's not necessarily higher than expectations, however. So that is an incremental driver of infrastructure stocks is potentially a little bit more limited than what we would have liked to see.
James, very briefly, every day we get selling from foreigners. Data shows us that large amounts. You're saying primarily a majority of that is still going into cheaper markets like China on the back of that reopening? Or are we starting to see forced selling as well to make up for losses elsewhere?
So there definitely is evidence of some degree of forced selling, particularly given the degree of losses that some funds have experienced in the current levels of market volatility. The overarching story here, however, from a JPMorgan perspective, is one of a sector rotation away beginning last November from a very well-held, relatively expensive India market into an incredibly underheld, relatively inexpensive China market, as investors started to play that reopening trade, the end of zero COVID, and now this SOE reform trade. We don't see that necessarily lasting the farther we get into the second half. And the critical thing that we're trying to focus investors on is the very significant conversation that occurs when we start to move away from a 2023 view and move towards a 2024 conversation. The relative growth rates of India relative to China start to look very, very different on a 2024 basis.
Right, James, great speaking with you. Thank you very much for coming on, joining us here on CNBC-TV18 this morning. Interesting thoughts. Thank you.
Thank you.
Well, 90 points down now. This is an absolute slam dunk. At least it's turning out to be like that. 16,882. So we, of course, broke yesterday's low very easily. It was not as if we got a big bounce from yesterday's low, but that is gone. And we are at about 16,877. The Nifty Metal Index was up 2% yesterday, and that is suffering quite a bit right now. Banks are down about 0.75%, the Bank Nifty that is. So it's across the board pressure. Market breadth was negative, it's worsened, and that stands at about 5:1 in favor of decline. So broader markets are seeing a crunching time as well. We'll come back with the management of Maruti. Shashank Srivastava of Maruti joins in. As its parent organization, Suzuki Motor Corporation raises stake in the company. We'll talk to him about prospects and how he's seeing demand pan out. We also will